has gone a long ways towards eliminating bank runs in the United States. Notice I said bank runs, not bank failures. There were lots of bank failures in 2008 and 2009, but we had precious few bank runs. You can always tell a bank run because the depositors line up in front of the front door. Right? There's generally a long line. They line up before the bank actually opens. So we rarely see that in this country anymore. In countries where either the deposit insurance scheme doesn't exist or is viewed as very weak, that is, the government guarantee is not viewed as being held, you still have bank runs. Yes, ma'am. Would deposit insurance be the preferred method? It would be one of the preferred methods, right? So again, you've always got trade-offs, and we'll talk about the trade-off that deposit insurance brings about. But you can accomplish the same thing with more reserves, right? The reserves have a trade-off. It's safer for the depositors and therefore the government, but it's also lowers the rate of return on bank ownership. So you've got that trade-off there. Deposit insurance has clearly worked in the United States and every other country that has a secure deposit insurance system. So from that perspective, it works very well. It is not without its own costs, however. And so you have people who are against government-mandated deposit insurance, but the bottom line is, how do we assess any program as economists? Marginal cost, marginal benefit, right? Where do we want to be? Did you have a follow-up? We'll talk about that a little later. So we will come back to that. Okay, let's think about the second kind of problem that financial systems can run into. And this is referred to as a liquidity crisis. It's similar, but not identical. And liquidity crises can happen to shadow banks, non-depository institutions, as well as depository institutions. Right? In this case, remember those borrowings, that layer of liabilities that was borrowings? So when we have a liquidity crisis, it's generally because those borrowings stop for one reason or another. The people who have been lending to us don't want to lend anymore. So again, we need to remember in this scheme, this is how we raise funds. Then we take those funds and lend them out. So we're not sitting on a bunch of funds here. These borrowings are relatively short term. In many cases, they're overnight. So let's think about what that means. That means our bank is going to borrow money with a promise to pay back tomorrow. With the money, though, that they borrowed, they made a loan that's not going to be paid back for 1 year. What happens tomorrow? I need to pay back that short-term borrowing. Well, how do I do that? I don't have any money. I lent it out. So the only way I can do that is go back into the marketplace and borrow some more. So I borrow $100 the first day. The second day, I borrow another $100, use that to pay back the first $100. And so these short-term borrowings are always flowing in and out over here to finance this long-term loan. At the end of a year, when this person pays us back, we can pay off that original or the last $100 loan that we have, and everybody's happy. Except when, for, again, some reason, the lender of the short-term borrower says, I don't want to lend to you anymore. Now what do you do? Oops, short-term borrowings go way down. The liability side of the balance sheet goes down. Assets and liabilities have to match. So somehow we need to bring the system back into alignment. Now, of course, there are several things that we could do, right? We could try and find more deposits. We could find somebody else to lend to us. We could try and find more equity infusions. Or we can sell off some of our loans, which has all the problems that we talk about with a deposit run. Right? These are long-term loans. They're relatively illiquid. Selling them off, especially if it's a lot and we need to sell quickly, is going to drive down their price, which creates problems all of its own. So somehow we need to find something to either replace the liabilities or we can only support a lower amount of assets. This, by the way, is what happened to Lehman Brothers. In the run-up to September 15th, 2008, Lehman Brothers was financing a lot of its assets with short-term borrowings. Now, to give you an idea, Lehman Brothers is a non-depository institution. It had no deposits. Right? So you had equity capital and you had a whole bunch of borrowings, mostly short-term. Remember that leverage ratio? So the leverage ratio for Lehman Brothers was about 30 to 1. So for every $1 of equity, they had $30 of assets, which also meant they had $29 of borrowings. So when you've got 29% or $29 billion in borrowings, you've got to be rolling over a lot of borrowings every single day. Roughly half of those borrowings were overnight. Borrow it one day, pay it back the next. Borrow it one day, pay it back the next. So if somebody decides they don't want to lend to you anymore, it develops into a liquidity crisis very, very quickly. Now, with a liquidity crisis, what we're assuming is that these are all good loans. Right? All we're doing is we're missing some liquidity for now. Other than that, we're still a viable institution. It's a short-run problem, not a long-run problem. So how do we fix it? Again, as we've just discussed, we could try to convert short-term borrowings to long-term borrowings. Difficult to do during the crisis. We can do an equity call, try to infuse more equity, issue more stock or whatever that might be. Or again, we fall back and have the central bank provide a liquidity injection. Now, one of the problems with having the central bank do that is trying to identify which institutions the central bank should do this for. Traditionally, central banks have been set up to be the lender of last resort to commercial banks, not non-bank financial institutions, not Lehman Brothers. However, what the central bank has learned through the 2008 experience is that there's a lot of interconnectedness between all financial institutions. And therefore, if one finds itself in difficulty, and especially if it fails, it's also likely that there will be collateral damage elsewhere in the financial system, which means that there will be collateral damage on the economy. So now, with Dodd-Frank, the Federal Reserve has the legal authority to lend to non-commercial bank institutions that might be out there. They do not, however, have the legal authority to lend to non-financial institutions. Okay, the third kind of problem we can get ourselves into is a solvency crisis. And this is by far and away the most severe type of crisis that we can get into. This is the kind where the bank's assets, the value of the assets, have declined for one reason or another. Right? So just think about, oops, you know all these loans down here? They're all bad loans. Nobody's going to pay you back. Oops, we got a problem. Right? We got a problem here. So you can think about these as mortgage loans made to migrant farm workers at 500 times their annual income, in actual case. You could call these any kind of loans that you want. But basically, this is a bad loan, or a loan that's gone bad for whatever reason. And the borrower is not going to pay you back. Right? So if you remember our flow chart earlier, a borrower has defaulted on their loan. The problem exists with the asset that the financial intermediary owns. So now what happens? Well, look at the way I've drawn this. These bad loans are greater than the amount of equity that we have. Since assets have to equal liabilities, if the asset side falls enough, equity capital will go negative. When equity capital is negative, the firm is insolvent. It's bankrupt. It's kaput. It failed. That could be a big problem. So the liquidity crisis that Lehman Brothers had, when they looked at it, also turned out to be a solvency crisis. In fact, the weekend that Lehman Brothers failed, there were lots of people looking at Lehman Brothers books. They were not only private financial institutions that the government was trying to encourage to take over Lehman Brothers, there was the government itself trying to decide whether or not they could, quote, bail out Lehman Brothers. It was broadly considered that Lehman Brothers, which came into the weekend as a liquidity crisis, was actually a solvency crisis. That the assets, the valuation of the assets on the book were less than the liabilities. So notice, these liabilities over here, Lehman Brothers doesn't have deposits, but all these borrowings, or if it's a bank with these deposits, they still owe this to the savers, investors. They still owe that. Well, they owe a lot more than the assets were actually worth. So in this case, you got a real problem. Right? You got a real problem. And in general, we can have several things happen. Banks can be forced to hold higher levels of equity capital. Okay, so higher levels of equity capital means a lower leverage ratio. A lower leverage ratio. But a lower leverage ratio means the return on equity will be smaller, which means profitability will be smaller, executive compensation will be smaller, nobody will want to work in these institutions, and no. So, more equity capital, less leverage. So think about what leverage means here. As I mentioned earlier, banks generally have a leverage ratio of about 10 to 1. It would require a decline on the asset side of 10% to wipe out all their equity. Lehman Brothers had a leverage ratio of about 33 to 1. It only required a decline in assets of 3%, 3.33%, to wipe out all their equity. Long-term capital management, a hedge fund that failed in 1997 or 8, I can't remember, had a leverage ratio of either 98 to 1 or 99 to 1. It basically took a 1 or 1.5% decline in the value of their assets to wipe out all their equity. More leverage, much, much greater risk if assets fall. It's not the liquidity risk that one has to worry about so much with high leverage. It's the solvency risk. If assets decline, one has a real problem. Now, what actually generally happens is the government will seize and liquidate the bank. This is true for small to medium-sized commercial banks. For other small to medium-sized non-depository financial institutions, they generally fail, disappear. If the bank is very large, what we now call too big to fail, there will be a bank bailout. Now, it is not true that there is any bank that is too big to fail. There are banks, however, that are too big to let fail. Remember, large banks have large relationships with other financial institutions as well as non-financial institutions. If you let a very large bank, the ones we think of as being too big to fail, then what you actually end up with is causing massive amounts of collateral damage in the rest of the economy. We actually thought that Lehman Brothers was the smallest of the 5 investment banks that were around at that period of time. And people generally thought, gee, they're tiny, much tinier than anything else. That's not going to be bad news if they fail. Oops, misjudged that. Lots and lots of collateral damage. So, bank bailouts for banks that are, or financial institutions that are too big to let fail. For smaller banks, and maybe for larger banks, another solution is let them fail. Take the collateral damage. Teach everybody else not to expect a bailout. Then they will manage their leverage ratio and their asset size of the balance sheet more carefully. Okay, we'll pick up here on Thursday, and we'll also do a little bit of a review, because it's my understanding that there's another party next Tuesday.